Hi, this is Bryan Rich from Money Markets TV. The sovereign debt crisis in Europe continues to dominate global markets, but a new threat is quietly emerging from a completely different part of the world. China has raised interest rates 5 times since October in an effort to rein in inflation, but they've been unable to get a grip on it. China's monetary policy is actually damaging the economy there, an economy that's been touted as our best hope for global recovery. The country's manufacturing sector has already weakened sharply, recording its worst month since the depths of the financial crisis in 2009. At that time, China followed the lead of other governments and passed a gigantic fiscal stimulus package, flooding the economy with easy money in an effort to keep economic growth going and keep its people employed. But China's economy simply couldn't absorb all of that easy money, and the result has been persistent inflation. The money ultimately spilled over into speculative assets, both in China and internationally, and drove an unprecedented appreciation in Chinese real estate. Now, the country is trying to engineer a perfect landing, putting a lid on inflation without crushing economic growth. It's a difficult feat for sure. If they fail, China's on the path of one of two outcomes: an inflationary spiral or a significant economic slowdown or recession. In outcome one, the masses likely rise up against the government because they can no longer afford the basics of life, especially food. In outcome two, the masses rise up because of massive joblessness. Either of these outcomes create big problems for the global economy, which has relied heavily on Chinese growth to drive the recovery. And unfortunately for China's government, and for the rest of the world, the cracks are already showing. Several indicators show that the country's real estate bubble is about to pop. And anytime that happens, the next place we need to look is to the banking sector. And in fact, financial crises historically tend to originate in the property market. China's banks are no exception. Moody's recently exposed an extra $540 billion of local government debt on the books of Chinese banks. That's in addition to their sizable at-risk real estate loans. Hedge fund manager and well-known China bear, Jim Chanos, has revealed just how overinvested the banks are, not only in Chinese real estate, but in fixed asset investments in general. In fact, never in modern history has a country been so heavily invested in fixed assets for such a sustained period of time. So, given the world's reliance on double-digit growth out of China year in and year out, and given the likelihood of a real estate bubble bursting there, we have to ask, what would the global economy look like if China slowed down to 5% growth? Who would it hurt? And the answer is everyone. Fitch Ratings estimates that that type of scenario would result in a 20% plunge in global commodities. And that would have a devastating consequence for many of the emerging commodity-rich economies that have been huge beneficiaries of China's massive stimulus spending. On top of that, China's been a stabilizing force in the European markets, keeping the sovereign debt crisis from spiraling out of control through its purchases of the euro, troubled sovereign debt there, and state-owned Greek assets. So if the Chinese rug is pulled out from under the global economy, I would expect another flight from riskier assets in the world, similar to what we saw in 2008. The bottom line here is the world economy remains very interconnected, and the busts associated with the great global credit bubble are still unfolding. With that in mind, as this next wave of financial crisis plays out, I would recommend staying defensive with your investments. I'm Bryan Rich from Money Markets TV. Thanks for watching.